We had a very interesting day's trading today in US equity markets, even though it was just a half day's trading. US equity markets definitely surprised to the upside. The S&P 500 rallied 15 handles, and this was a surprise because I was expecting the same type of volatility we had last week, and I was expecting more declines, which we didn't get at the open, but I was definitely glad to see the S&P retrace an awful lot of that rally. It gave back 10 handles of that rally. It just finished up 5 handles on the day, so that was encouraging. So we may get more downside pressure towards the end of the week. I think the best way to play this from an investing standpoint is to just stay long, and that's what we're doing in our premium portfolio. It's just staying long our long-term holds. A lot of our stocks are much cheaper than the market from an earnings and sales standpoint, so they should not decline as much as the market. I'm guiding maybe down to the 2250 level on the S&P 500, maybe down to the 2200 level, which would be something in the region of a 10% move. And you know, we're holding stocks like L Brands, like VF Corporation, which, you know, are stocks with strong competitive advantages, much cheaper than the S&P 500. So even if they do decline from their present levels, I don't think the decline will be played out over a long period of time. It should be short-lived, and these stocks should rally back up above the prices they are trading at present. From a shorter term trading standpoint, for traders who are maybe trading option positions, you know, if you're trading this from both sides, maybe with credit spreads, again, I would caution in trying to short this market. Like, all we have to do is make new highs in the S&P 500 for this long awaited decline to be drawn out, probably another cycle. And that's the danger with trying to have too many short deltas at this present moment in time. You know, at any time, like we had today, a light trading day, volume is light, and all we probably need is the S&P to rally a further 20 points for another daily cycle to ensue, which would probably delay this correction another 2 months at least. So I would caution investors, whether you're trading this from a trading standpoint, short term, or from a longer term standpoint, is to have enough long deltas in your portfolio. Short deltas will, you know, it's just too risky to be heavily short this market, because I do expect the market to bounce back, even if we get this 200 point correction, which I expect we'll get in the not too distant future. I got a question there from a subscriber: why do I think that the market will bounce back when we do get this correction? And it basically comes down to the robo ratio, which is a guide on how retail traders are trading at present. It has gotten very bullish, but it's not been backed up by the commitment of traders. Commercial net short contracts, again, there's just too much short still in the market despite the market being at all-time highs. So we can't really have a permanent cyclical bull top until everybody's on the same side of the boat. And then what happens is that any bit of selling, then everybody just runs from the exit, but we're just nowhere near that situation at present. Quick update on oil. Good day in oil today. Oil was up 2%. Energy stocks rose. We are long Chevron. XLE also rose, which is the ETF for energy stocks. ERX also rose nicely, which is a leveraged ETF for ETF stocks. Gold continued going down. I expect this to continue. The May lows and the March lows now definitely look within sight and probably will be taken out before this intermediate cycle bottoms. So again, probably the three of these markets, I do see them all going up eventually. Equity stocks, or equities, gold and oil. Oil seems to be in its initial innings of an intermediate cycle. Stocks seem to be near an intermediate high and should be rolling over any time now, although we have seen before these declines can be aborted very quickly, which is only adding more risk to the market. And gold seems to be caught in an intermediate decline. So if you're looking where money should be, asset capital should be, still should probably be in the stock market, because that's where protection seems to be. I would not have much capital in precious metals at present unless you're a long-term investor willing to hold through meaningful rallies and troughs. And oil, definitely, oil looks to be starting a brand new rally, which should last another 2 to 3 months.